Very much, Jack. Let me maybe start with two questions. So I guess in Europe, for many countries, this reform came as kind of a shock. I mean, it's been announced that there would be a reform, but I think people didn't expect, the magnitude of reform. And when people, from Europe look at this reform, one issue clearly is, the impact, combined with the personal tax reform, the impact on government finances. I think the current U.S. budget deficit is like 6% of GDP, or 5 or whatever, and it's going to 7 or something. This doesn't really look sustainable. So so one wonders, what is the strategy behind that? You could say it's a commitment to spend less in the future. But the question is really, how will this play out? I mean, I guess all these changes in 5 or 6 years are kind of anticipated tax increases, so they are already factored in. So you really wonder, what is the logic behind that? Is it really this idea of committing future governments to cutting the spending, or what? And then the other question is, if you look at Germany in particular, I mean, what you talked about reactions of other countries, but what would your suggestion be? I mean, this is a country with things like earnings strippings rules, interest limitations on interest deductions, relatively tough transfer pricing rules, and a corporate tax rate of slightly above 30%. Depending on where you are. So what would be your advice? I mean, one option, I guess, would be to cut the corporate tax, respond by cutting the corporate tax. Another option would be do nothing. In Germany, a lot of people say, we don't want to intensify tax competition. I find that funny. It's like Mercedes saying, oh, Volkswagen has cut its prices, but I don't want to intensify this competition, so I just let all the clients go. It's a bit strange, but still, you could say that. Or Germany could try and extend its taxing rights. Further reducing interest limitations. So, I'd just be interested in what your recommendation would be for Germany.
Well, I would hate to, as a Canadian, come here and talk about what Germany should do. I do have views of what Canada should do, but I'll get to that in a moment. But let me say something first about the deficit in the United States. There is some question about how big of an impact this tax reform will have. Most of the macroeconomic studies that are done on fiscal deficits, they tend to look at everything in terms of demand, fiscal stimulus, and things like that. So the Joint Committee on Taxation, running it through their models, which tend to be closed economy models, they estimated that the $1.5 trillion cost of the U.S. tax reform would in the end be $1 trillion over 10 years. And in the discussion I had with Marty Feldstein about this, Marty made the point. He said, well, the debt GDP ratio is expected to be 90% by 2027. $1 trillion on what will be probably a $30 trillion economy by 2027 is 3%, and some relatively small numbers. So he said he felt this wasn't a bad price to pay for tax reform. And it's also interesting, everyone, when it comes to tax reductions, they seem to raise the deficit issue a lot, but they keep forgetting that usually when it comes to new spending, they don't worry as much about the deficit. This, I find that in Canada. So there is an issue, but you can make a question. Certainly there's going to be rising interest rates. Monetary policy worldwide is going to go through a major change in 2019. If you look at the 2018 numbers, between European, UK, Japan, and Federal Reserve, even though the Federal Reserve is going to be selling off its assets, still on a total net basis, there's still going to be quantitative easing in 2018. There'll be more assets sold by the 4 banks than bought. That changes in 2019, and I expect that interest rates will even be more pressured to rise starting in 2019 worldwide, and so that will make the deficits more expensive, and also the growth that's happening right now in the U.S. We're getting into labor shortages again. Part of that is due to the aging economy, And so all those things, I think, are going to put pressure on interest rates. You know, and this deficit issue in the United States will be important, not less important. Certainly that, you know, by the way, Kotlikoff in his model, he predicts that, you know, based on his model, which may be, you know, maybe an outlier, but he actually finds that the tax reform will almost pay for itself. We got to remember that, you know, there is a lot of base broadening in the tax reform, but so it's not just a cut. It's also base broadening. It just doesn't make it up the whole way. So the question is how much growth you get. In his model, he gets more growth, so he actually gets the reform almost paying for itself. Whether that's true or not, we'll see. You know, it all depends. But he's got a general equilibrium model, and it's a lot more supply effect that comes into that model. But I think in terms of tax responses, I think countries with higher corporate income tax rates like Germany may need to think about reducing it. Not so much from an investment attractive point of view, because the German system isn't that bad, you know, in terms, and it's a major country and has a lot of other positive aspects to it. So I'm not sure from an investment attractive point of view that's critical to cut the corporate income tax rate in Germany. But I think the base erosion issues, I think, are important. And Germany could try to tighten up on some of the international stuff more, but then you want to give something back too to the corporate sector, and that would be through a corporate rate reduction, which also helps with base erosion. So I can see doing both things in Germany, more attention to some of the base erosion policies that could lead to more revenues coming into the German government, but then giving some of that back through corporate rate reduction, which also would help with base erosion. So that would probably where I would stand. Now the other question is whether you want to make some other changes that might be appropriate. I know that I've been reading some of this really good work coming out of here and other places on land transfer taxes, real estate transfer taxes. We have that in Canada. I recently been working with Ontario on their land transfer taxes. When it comes to commercial property, it's almost impossible to levy it. Like, why do you have a real estate transfer tax on commercial property? It's absolutely insane. Because how do you define a purchaser? And so there's all these gimmicks that everyone has set up in terms of nominee trusts and all sorts of other opportunities where you can avoid showing a change in ownership. And the U.S. tries to do that through their change of ownership rules, but it's not perfect. And it is, and not surprisingly, and I haven't seen too many estimates done on commercial property, but the work that I've seen coming out of Germany and Australia and some other places is that generally a lot of these real estate transfer taxes are almost as bad as a corporate income tax in terms of distortions. So maybe there's some thought should be given to the kind of a more major tax reform, trying to go to some other types of levies that could be paid by businesses but won't be as distortive as well. So maybe more thought should be given to these things.
Any questions, comments?
So I have two short questions. The first is, how does this tax reform compare to previous tax reforms in the US, in particular the one in the 80s when Reagan came into office? And the second is that, you know, in many Western European countries there's an issue of policy convergence, and voters are disappointed because established parties implement quite similar policies. You can't distinguish anymore between left-wing and right-wing parties. And as a consequence, there was electoral success of new populist parties entering the political arena. So against this background, you know, you could argue that this is a super positive thing. So Trump seems to deliver. There's a Republican guy voted into office, and he's implementing a major tax reform, decreasing corporate tax rates. So what do you think about this?
So the first question was on
other tax reforms.
Yeah. So the Reagan tax reform. If any of you want to read the story behind 1986 reform, one of the best books I ever read was Showdown at Gucci Gulch, which was Gucci being, you know, all the on K Street, you have all the accounting firms and legal firms, and they all wear Gucci watches and things like that, the lobbyists, and et cetera. So that's why it was called Gucci Gulch. But it's a great story about how Reagan tax reform took place. I would say there was a major difference between this and, you know, and what happened. The 1986 reform, first of all, was bipartisan in the end. You didn't really know what was going to happen until the very end because of the way the U.S. system operates. They also didn't have, it was also revenue neutral reform. In fact, they raised taxes on corporations and cut them on individuals in that reform. Charlie McClure wrote the fundamental paper from the White House that gave, you know, like a whole full-scale reform, and then it was up to Congress to go through it and decide what to do with it. And they did make a lot of changes to what the original White House proposal was, but the idea of cutting corporate tax rates significantly at that time, 48 down to 35%, which they did, and then the personal tax rates, a major reduction to 25% personal tax rates. You know, it was a pretty big change at that time, and it was bipartisan. Now, you would think that given it was bipartisan, it would stick. But more and more legislation came in year by year in the United States, undoing, especially the personal tax side. It didn't stay the same. So a lot of the base broadening that was done, some of that got reversed. New things were introduced, new incentives and things like that. And so by the time you got to 1996, 10 years later, you know, thousands of new pages of tax legislation was brought in by Congress. You know, after the 1986 reform, some of the major things stuck, especially the rates, although the personal tax rates started going up. They didn't stay at 25%, obviously. So, or was it 28? Anyway, you know, it was a much lower number. So that did change, and of course, eventually they moved up, you know, to 39.6% top rate in the United States. So the personal tax side, I think, just tends to get monkeyed around all the time by Congress, and I expect, that's why most people, they don't know what to expect with this reform in 5 years' time. This one was not bipartisan. This was completely partisan. So the Democrats don't have ownership of this reform at all. So eventually, if there's Democrat control of Congress and the presidency, which will happen at some point, I'm sure, in, you know, in whether it's 2020 or 2024, I'm sure it's going to happen. And then the question is, what would they undo and what would they do? Most people would expect that they're going to keep lower personal taxes on middle and lower income individuals. Maybe the top rate would go up again. Would the Democrats bring back state and local income tax deductibility in the United States? Because that hammered the Democrat states particularly. They might do that. But then, you know, that's a big benefit to higher income individuals. So the Democrats have to explain that. So it's, you know, we'll have to see what's going to happen down the road with the reform. But I think on the corporate tax side, there was actually a lot of agreement between the Democrats and the Republicans in the past about the need to deal with the corporate tax system, and that the tax on dividends was not working, and the tax, you know, that parents would bring from abroad, you know, this whole thing of leaving $2.5 trillion of money outside the United States, it just was a really negative thing for the U.S. economy. And so they, you know, there was a lot of common agreement about moving towards an exemption system, at least, although there was also some proposals by the Democrats to go to full accrual taxation, you know, like tax all foreign profits, not reinvested profits as well. So you may have, you know, some people in the Democrat Party of that view, but I think generally that system is not going to change. I think that's going to be permanent. And as I mentioned, I think the lower corporate income tax rate, it could go up. You know, I won't be surprised down the road if they do try to raise it, mainly for deficit reasons. But I doubt very much anyone will want to go back to 35%.
Do actually unified Republican state governments? Do actually unified Republican state governments invigorate this reform by also implementing market-oriented policies at the state level, decreasing taxes?
This is the interesting thing now. Now tax reform has gone from one level of government, and it was a big surprise this reform took place, although I felt it was going to happen, especially after healthcare reform died in the United States. But now what's happening in the United States is that it's now moved from one level of government to 50 governments, and all the state governments are now trying to figure out what to do with this reform, because some items like the interest limitation will give them more revenues if they adopt, if they don't have to harmonize with the U.S. system, with the federal system. They can adopt their own corporate tax, but to the extent they harmonize with the U.S. Federal tax, if they adopt the interest limitation rules similar to the federal one, they'll get revenues, and that could allow them to do some other things. So, so they're all now going. Every state government is going to go through tax reform now this year. So there's going to be a lot more changes that are going to be coming about this 2018 period. The other thing is that the technical bill, or what I would call the technical bill, is not written yet in the United States, and this is all the rules behind the law. And some of that, there is a whole process that Congress has to be revenue neutral, the way they write up all the regulations and everything else. In other words, it can't change the amount of revenues that are coming in. But they have to write up the rules, and some of these things are not well understood yet. And so, the parties all have to, the Congress, all the members have to sign off to the regulations. So that's going to take some time to develop over this coming year. So there's still a lot of work to be done.
Okay, what sort of a reaction do you expect from China and Japan?
Well, Japan has been lowering its corporate income tax rate for some time now. In fact, they went below the U.S. I think I have the number. I don't have it here, but I think, their corporate rate I do have here. I think they're at, this is including all the prefectures and the local governments, and Japan has like 4 levels of government, so it's really fun. They're 30.9, so they're a little above 30. They've already reduced it. Abe has been kind of like wanting to see more investment. They have some other aspects in their system, like this tax on fixed assets. It's actually quite significant as a tax on capital. Maybe they'll look at some of their other things they're doing in reaction. But I think that he will want to try to maintain the competitiveness of Japanese companies to some extent. So I think I would expect some more changes in Japan as a result. France actually has a whole bunch of taxes on businesses, and not just the corporate income tax, but Macron has already announced a very significant change. Whether he goes further than what he's already done, I'm not sure, but he's bringing the corporate tax rate down, I forget, maybe it's 5 or 6 percentage points in Japan, and doing some other changes as well. So we'll have to see. China, I think, is a really good question. It's a very different kind of system, because it's very heavily government controlled. There's an industrial policy involving a lot of subsidies towards businesses, protection of state-owned governments. So what does a tax paid by state-owned enterprise mean? Is that really a tax, or is that a dividend paid to the government? And so the implications of taxation, I think, at the corporate level in China is different. But I think the Chinese corporate income tax rate is not too far right now. I think it's 25%, so it'll be similar to the U.S. one. They may not, but China recently has been trying to do some things to improve the competitiveness of their corporate tax structure. For example, they brought in more refundability under the value-added tax. At one time they didn't have any refund for any value-added tax on machinery purchases. 17% tax on every dollar on every machine you bought as a Chinese company, and they've brought in full refundability about 5-6 years ago. Last year they had like 3 real estate transfer taxes. They eliminated one of them. So they seem to be knowing that they need to do certain things to help them. But I'm not sure the kind of pressures in China. I just don't know China well enough.
I would have two more questions maybe to conclude. So the first is, what is the impact on tax havens, low tax countries like Ireland and Switzerland, or places like Bermuda? You mentioned these 2.5 trillion lying somewhere. So what is this? Is this just, let's say, you know, Apple, Ireland having some bank accounts in the US and now not, you know, this, you know, just the ownership of these bank accounts being transferred to, I don't know, Apple US, which would mean very little real effect? Or will this be sort of a big capital flow leaving these places? And, you know, so to speak, bad news for the tax havens. And the second question would be, I mean, if we look at this, so the US going to 21, the UK has announced they will go down to 17. France wants to go to 25. And a lot of people, of course, wonder, where is this ending? I mean, where is this international tax system going? Is the corporate tax going to disappear, or will it be sort of similar to the value-added tax, or even lower than the value-added, you know, some tax of, you know, between 10 and 20%, but not what it used to be? Or is it moving towards fundamental reform? So what's the sort of future of the corporate tax system in the long term?
Those are all big questions, but anyway.
That's why I ask you.
So first of all, on the tax haven side, I think, and I've seen this a lot with transfer pricing arrangements, especially around intellectual property. So there's been a great use of Singapore and, well, especially for U.S. companies, but Singapore and you know, in the past Barbados, although they chomped on that one a bit in the United States, but there's been a number of tax havens around the world that U.S. companies have been able to put their profits, Netherlands, Antilles, etc. Luxembourg is another favorite one, and things like that, and to park their money there. And they do it partly through intellectual property by licensing, you know, licensing the intellectual property to a subsidiary. So this is where the GILTI tax will come in. So those jurisdictions where basically you just have a lot of intangible income being earned in that jurisdiction are going to be particularly affected, where there's going to be much less incentive to put your intellectual property there. You may be better off putting it into where you have more tangible assets in a foreign country with a low rate. So I'm not sure how Ireland's going to be affected, you know, to the extent that there's actually real activity that goes on in R&D as opposed to just putting intellectual property in R&D. So that will certainly have an impact. And it is true that in terms of the bringing back money to the United States, it's more likely cash that's going to be brought back than selling off investments and bringing it back. I don't think that's going to happen as much, because to the extent you have investments that are making good returns, why would you sell them off? What you might do, though, is push, as I said, push more debt into those countries, and then that would lower your earnings and profits there, and at the same time you can bring the money home and reduce your own debt that will be less subject to these interest limitation rules. So I think that's what I would expect is going to be happening, particularly. But I think you will see these capital shifts, and we'll see how much impact they are. One estimate I saw, and I think it's going to be an underestimate now, is, you know, maybe $300 billion will go back to the United States. I think it's going to be higher. I mean, just, yeah, you know, when you look at what Apple did alone, 55 billion is quite a bit. And if you've got Amazon, you've got a whole bunch of companies that may return money back to the United States. And so I suspect the number will come out higher than 300 billion. But I don't think it's going to be 2.5 trillion, because a lot of that money is invested in good assets and good projects. In terms of the long-run implication of corporate tax reform, actually, and, you know, we've been writing a report on corporate tax reform, what's happening throughout the world year by year, and the past few years, I would say, have been relatively quiet. There's still been, on average, reductions in the corporate income tax rate, but not very big. And I've always argued that the real tax competition is around profit, where you put your profits, because you don't have to move people or machines or change your business activity, but you can easily move profits, whether it's through debt, transfer pricing, or whatever, financial structures, etc., intellectual property, and that's very sensitive to the statutory corporate income tax rate. And so I'm not surprised that we've seen policies where we've seen reductions in corporate rates where there's competition, But then, on the other hand, less competition or for actual real investment, and so we've seen more base broadening in a number of countries over the years of different types. What this reform does, especially with the expensing, I think might make some countries adopt some, investment tax credits and depreciation deductions that they wouldn't have done otherwise, rather than reducing the corporate rate if their corporate rate is already close to the U.S. rate. So they may not look at the corporate rate as, to continue reducing it. What does this mean to the future of the corporate tax? Well, that's a long discussion. I've always been the view the corporate tax will not completely disappear as long as we tax personal income and or individuals, because people can, if you didn't have a corporate tax, people can shelter their income in a corporation and avoid tax altogether. And that became a real problem as these corporate rates have been going down around the world, and personal tax rates at the top end have been really high. In many countries, including our own, people were putting money into private corporations in order to have more deferral of their tax on personal income. And you can't just kind of separate that group out from another group and things like that. I think the world is a lot more complex to do that. So I've always been of view that, countries will always be balancing these things. As long as they maintain a personal tax, which is very popular, especially because of its progressivity and its impact on income distribution, that I don't see the corporate tax falling away completely. And if governments want more revenue out of governments, companies, they may look at other potential levies. Some of them may be good ones, like user fees, as opposed to corporate income tax.
I think what we've seen is that this is really a major change in corporate tax reform, and I have to say I draw some comfort from the fact that we're not the only country where the government seems to say, we just do nothing and wait. I guess when the impact is there, maybe that will change, but that might be too late. Here is a last question, and then we should conclude.
What will this tax reform do to the current balance of the United States? If there are so many capital imports, I guess the current balance deficit should increase. Is that correct? In fact, that was an argument, if I recall correctly, at the Reagan tax reform in '86. And in fact, I guess it was Hans van der Zinn who argued that way, that this, in particular, the investment depreciation at the time, now investment tax credit, increases investment, increases capital imports, and increases the current balance deficit. But that's not exactly what Trump wanted, or is that correct? Yeah. But my other question is just the opposite. You said the financing of this tax reform will lead to higher interest rates. But if higher interest rates, if interest rates are rising,
which they are in the U.S.
The user cost of capital goes down because of the tax reform, but at the same time, real interest rates go up. So that should perhaps not outweigh, but at least go in the other direction.
Yes.
So it's not quite clear to me how big the impact on investment really is, finally, if you include these macroeconomic repercussions.
Yeah. Well, I think that's just on the last point. General equilibrium models like Larry Kotlikoff's do take that into account, because that, you have you're looking at the demand for capital, supply capital worldwide, and if there's this increase in demand, especially by economy that's 20% of world GDP, which is the United States, that obviously that's going to increase the demand for investment. That will cause interest rates to rise internationally. As a result. So, and that will feed into a higher cost of capital, so it blunts some of the impact of the tax reform. But doesn't mean it completely offsets it. I don't think that's going to happen. On the exchange rate, people have been projecting that the tax reform itself would actually cause the exchange rate in the United States to rise. And that's because you would have more capital inflows coming into United States. And of course, if that happened, that will push up the exchange rate, and of course it'll make it more difficult to export. and therefore cut your net balances on and your increase your trade deficit in the United States, which is of course counter to what Trump is trying to do. But you can also argue that's going to give him room for more trade restriction in the United States, because now he's got this pressure going on the exchange rate, and he's happy with the falling exchange rate. Now, what's really surprised people so far is that the exchange rate of the U.S. dollar is still falling. They expected that it would start rising in the start of 2018, but it hasn't. And it's a good reminder that there are many things that affect exchange rates, some people have argued that this concern over trade actions and things like that is actually pushing the U.S. dollar down right now. So I also think that the way of looking at the Trump administration, it's an overall economic strategy that he's really had right from his original campaign, which is to undertake deregulation, tax reform, track more investment, bolster U.S. growth, create more jobs for those people that have been displaced. But then at the same time, he would toughen up on trade, and in fact, his argument being, we've gone into these unfair trade deals. We want to have corrections to what's happening right now. And there has been an increase in both countervailing and anti-dumping duties in the United States over the past year. I think you can expect a lot more of that in 2018. And so that's the other shoe to fall. So he's already done the first part of the strategy, but now the question is the second part of the strategy, which will be the trade strategy. And that's one that worries me the most, actually. As an economist, I think free trade's a good thing, but I do understand these issues that happened over displaced workers and people who weren't protected from these changes. Also, we know that free trade hasn't been free trade worldwide. There's been a lot of intervention by governments in trade policy, even under free trade agreements. And in fact, the objection that the United States has over China is the heavily subsidized industries that have been intended to grab international market share in a number of commodities. And that's what they want to go after. So the actions we've seen yesterday on solar panels, for example, that was China that deliberately subsidized solar panel manufacturers to grab the international share of solar manufacturing, and they did. And in fact, there was a study done. I saw, and I forget who did it in the United States, which university and who the names were, but it was done on the impact of China penetration in the United States. And interestingly, the areas where there was significant loss of work, jobs and things like that, and again, they did try to deal with the financial crisis and other things that happened, but they argued that there was this displacement, particularly by Chinese imports into the United States, that were especially in the counties that Trump won in the last election. So that's why this whole trade thing is he's got this particular mindset going back to basically a mercantilist trades policy worldwide, and in fact I think this is the thing to watch over this coming year, and that could end up causing the U.S. dollar to fall as opposed to rise.
We are at the end of the seminar. I would like to thank you, Jack, for this presentation and all these explanations on something very complex. I would like to thank you all for being here. As always, there are drinks next door where we can continue the discussion. Thanks for being here. Thank you. Thank you.